All right. It looks like we're live. Hello, everyone. We're going to have Clive join us as well later on in about 10 minutes. If you're watching this recorded, you might want to skip about 10 minutes forward because I'm just going to greet the viewers right now, and you might not be interested in that, or you might. So let's see who's here. There's quite a few of you here already. Dutch Libertarian, Darren Smith, Pablo Pina, Echo's here. Chris Gonman, hi Chris, Dutch Libertarian over here. Melissa Bailey, Chris Tippin, Andrew Arama. Nice to see all of you. The title today is The End is Nigh for the Bankers Scrip. Well, for those of you who are students of fiat currency, that's what it is, banker's scrip, not really backed by anything. It's backed, I guess, by taxation. But that's getting a little bit difficult for them to justify, and the private economy is getting more and more lumbered with taxation, with inflation, and the public debt is ballooning, and it doesn't look like it will stop ballooning. Multi-stackers here, greetings, he says, or she. Tom Shosun from Norway. Norwegian Krona down 20% to the euro in the last 2 years. Yeah, it's down even more versus gold, real money. And it's weird because you'd think Norway, with its oil wealth and natural gas, I guess, wealth, would be doing well, but not necessarily. Yeah, I've had to switch the angle here. Blue Water Stacks, thank you for your super chat. Says, thanks for guiding us through the financial system blowing up. Well, yeah, I mean, I found the purpose of what I learned for the last 25 years almost, some years ago. And I thought I'd put it to the test and warn people about it. Yes, some people might say it's always the same and it's always repetitive, but it has to be because that's the way the system has been built. The fiat currency system is not fit for purpose. It always, yeah, it never ends well because it's a system that is best based on, I would say, fraud. It's not real wealth. It's created out of thin air by a small group of men and women. And yeah, I think it's one of our hopes that it implodes and collapses because the world's getting crazier and crazier. And that's just a symptom of the fact that the money's gotten crazier and crazier. We're going to look at a couple of charts that shows that. And they're quite long-term charts. Long-lived coins, says Amaneko 64. Lara Pizzicoli, Ciao Pablo, she says. Waking up fast. Good evening to all of you awake and alert, lovely people. And thank you, Mary, from the northeast of England. You're welcome. Sylvie says, you're a wealth of knowledge. Well, thank you. I try my best. Darren Smith is here. Tom Miller, Io Silver, In That We Trust. That's a good one. How long, for how much longer are we going to trust in that? Don't fight the riptide. My wife is amused by your delivery. Calm, dry, wit while expressing calamity. Yeah, I mean, the thing is not, it is calamitous, but I think on the other side of the calamity, things will be normal. I mean, I lived through calamity in Brazil in terms of the system, and Brazil's still standing. I know there's a lot of crazy things going on, but in the last 50, 60 years since I was born, we probably have had in Brazil, where I was born and grew up, about three currencies and resets, but things keep going. It's just the people that depend, the people who run the system, they'll get hurt, and the people who have too much exposure to the currency, they'll get hurt. That's why I keep harping on about having hard assets, about having gold and silver physical outside the system. Frank Kavija, thank you for your super chat. He says Rafi Farber's end game will play out. Yeah, it's only a matter of time. Silver Task, thank you for being a moderator. And he says hit the like button. Zapinator says, hey Mario, James, you want to hope it doesn't implode and explodes. Let the dollar go the way of the pound in the 1920s. Haunted Hillbilly says, hello, Mario. When will the common men wake up? Uh, Probably, unfortunately, when it's a little late. Yeah. Over here, what about October 1st and gold to be a tier one asset? How does that deal with the bank solvency? I think the Basel III tier one, well, it's an asset that can be used to calculate tier one equity for banks. Gold is not actually a tier one asset. Well, yeah, gold is an asset that can be used to in the calculation of tier one equity for banks. I think it's been happening already since 2023. I'm not sure it will be October 1st. I think what's more important in October is the BRICS summit in Kazan, Russia. It's from October 22nd to the 24th. Jason Silverton, greetings from Südtirol. All right, that's the German part of Italy, Südtirol. German speaking, that is. Andrew Brown, hi, Mario and Rudy. Greetings from the Scottish borders. Do we need a gold standard if ethical, incorruptible personnel can be found to manage the money supply? I'm not saying we need a gold standard. What we need is a free market. And yeah, we don't have to be under a gold standard. We just have to use gold and silver coins for money. Gold standard means that only gold is legal tender. I don't think we should have legal tender laws. And yeah, the government might want to mint the coins for the public, but can we trust the government? I think we could trust the mint, but why not have private mints? There were private mints in the U.S. up until 1861, before Lincoln got the legal tender law through. I think it was 1862. And then it was downhill from then. Big Bush Ape, excuse me. Thank you for your super chat. Keep stacking. Been watching for years. Thanks. Oh, you're welcome. Yeah, Basel III is important, and I think it shows. And I'm going to also talk about the IMF today. Frank Avija, thank you again for your super chat. How do you think precious metals will play out in the next 2 months? I think the Fed cut is already priced in. Technically, the precious metals look pretty good, actually. I think at least gold and silver should follow suit. Frank. Hi, Clive.
Good evening, Mario. How are you today?
I'm fine, and you?
Very good, thank you. What's the subject tonight?
Yeah, it's the let me have a look here at the title again because I let's see, I forgot the it's yeah, the it's like we're live. Hello everyone. Hold on. What am I? We're gonna have Clive join us as well later. Don't want that. Sorry. There's another screen. Yeah, the end is nigh for the banker's script. Of course, I mean fiat currencies. And I'm gonna go ahead and just share what I wanted to share here, Clive. One of the reasons why I think things are not good, not just for the dollar, but for all the world's currencies that are basically a derivative of the dollar. And it's this chart here. Um,
Oh, that looks like a good investment. What is it, Mario?
Yeah, it's gold in
Oh,
dollar terms. Yeah, and it
surprise,
goes all the
surprise.
way back to 1833, Clive. Um,
Yes.
I mean, the scale is
That's a log scale, isn't it?
yeah, yeah, and the years as well. They go 1833, 100 years just here, and then 100 years of that. So they've kind of squished everything in. But one thing I think is good is which, well, very telling here is that you had 100 years of pretty much steady, the dollar was a weight of gold. 1 ounce was $20.67. Had a little blip here in the Great Depression. And then, of course, Roosevelt, they devalued the dollar and it got up to 35. But then it stayed there for up until 1971. But when we look after 1971, it's no wonder, Clive, the world's gone so mad because we've gone from it being a stable, a measure of weight and value to being completely, it's a crazy chart. And the other thing is, I think is going to get crazier because we just broken out here. This is a monthly chart. And that's why I think it's important to look at the bigger picture going back almost 200 years.
Yeah, I mean, on the breakout, I think we're looking, if we want to see a really fast spike upwards, I think we need to see 2026 today. On Friday, I put the figure at 2027, but that number's coming down slightly. We're in a very clear flag pattern. And if you follow charts, when you see what's called a flag pattern, which means when the price rises rapidly, then consolidates from it, going left and right, up and down, and getting the vibrations are getting smaller and smaller. When it reaches the tip of that point, it breaks out either to the upside or the downside. And usually it's to the upside. But where we are, we're sort of somewhere down that flag pattern. So a breakout to the downside would be maybe $10 or $20 below where we are now. Breakout to the upside would be about $20 above where we are. So I'm putting the figure at 2026 today, and the day before on Friday it was maybe $1 higher, and for the breakout on the downside $1 lower. Um,
You
so
mean
keep your eye on.
25, 26?
Yeah, yes. I'm sorry, mate. I mean 22. What are we? 2,526 is the
Yeah.
breakout point.
Yeah.
Um, so if we get above that, I think we're on the races, probably very in short order down to 2,550.
Yeah.
That would be my view.
I think the
And
recent high, sorry, the recent high, the all-time high so far is in the spot price is 25, around 25.32. Yeah, I think so it's similar to that 26 you're talking about. And I think we could rapidly go to 2600. Uh, and I think this week, I know tomorrow is a holiday in the US, but Friday we got the non-farm payroll, so that will probably be a big number.
yeah, and just looking at a chart here, the gold price chart that you've got on the screen, the reason why the gold price was very steady was because the dollar was expressed as a particular number of grains of gold. And when Roosevelt devalued the dollar, or rather increased the price of gold, as people say today, what he was actually doing was reducing the number of grains of gold in a dollar to approximately half what it was before. And that's why the gold price went up, but I'll put it another way, the value of the dollar went down. And when that did happen, there were a lot of people who were very upset with what happened because first of all, the day before that, he increased the dollar. He'd taken all the gold which belonged to the Federal Reserve and acquired it for the Treasury. So the Federal Reserve weren't too happy because they missed out on that huge gain in the value of the gold, which then belonged to the Treasury. He did pay the Federal Reserve at the time, but with the dollars of the day, i.e., $20 and 67 cents an ounce. But the other big losers were the foreign nations, the bankers in London, the bankers in Paris, the bankers in Zurich, and all around the world. Bankers who owned dollars, who thought they were gold, suddenly find that they weren't. They didn't have as much gold in their dollars the day before. And of course, the trick was repeated, but in a much worse form in 1971 by President Nixon, when he suspended the gold window temporarily, as he said. And of course, that temporarily, we're 50 years later now, and we're still
Yeah.
waiting for that temporary ban on converting your dollars to gold to be removed. But of course, once that constraint of the dollar being worth gold or the gold being priced in dollars at a fixed rate was removed, it meant the government and all governments around the world were free to print as many, well, the American government could print as many dollars as they wanted, but all the other countries which were linked to the dollar, the faster they printed the dollar, the faster other countries could print their own currencies. And that's why we see if you turn that chart on its head upside down, you're actually looking at not the gold price going up, but the
Dollar.
value of the dollar going down.
Yeah.
And you can see it was worth $20 or so in 1930s, and it's worth 2,500 now. So what's that? That's a 1/100th of what it was worth.
Yeah, and in 1933 as well, what Roosevelt did, he took the U.S. off the gold standard internationally, so a lot of foreigners could not take their dollars and get gold from it. And then it was only in 1934 because the international price of the dollar was going down already. Because I've been reading this book about the Great Depression, and it went up to like 35. So Roosevelt took that level and said, "Now we're back on the gold standard, but you're only gonna get you're gonna you know, you're not going to get as many grains. And I think, yeah, people lost out. But I also want to show a chart of silver because I think silver could do really well as well. And this one goes back to the to 1800. And this spike here, this little spike here, I think was the War of 1812. I took a screenshot of this chart from TradingView because if you leave it live, it changes. And this was, I think, the Civil War and afterwards. But this line here, Clive, it's around 129 per ounce, and that's what the dollar used to be. So the silver dollar is like 0.773 of an ounce. So it's interesting that that's the how many grains of silver should be in a dollar. And even before it took off in 19 in the 70s, we saw it retest that level after it went up quite a bit here in the late 60s, early 70s. We saw it I don't know. Okay, we saw it retest that level, and from there it went almost straight up to like 50. This is a monthly chart, closing chart. So the yeah, I think the closing high is like 35. So actually, we're pretty close, and the trend looks pretty bullish. I don't know how far up it's gonna go, but you can see this period here. This is this is when they demonetized silver, 1873, I think. And up until 1963, um, they basically kind of kept silver under its true value. And not surprised that it took off after that. It was not just about the Hunt brothers, in my opinion.
While you were talking, Mario, I just brought up the supply and demand for silver from the Silver Institute. I don't know if you want me to share that with you.
Yeah, you can
Uh,
share.
okay, let's
Yeah.
bring that up here. Uh, that one. So, do you see what I see now, Mario?
Yeah.
So if we look at the mine production in 2015, this is in millions of ounces. In 2015, they had 896 million ounces that were mined. And as you can see, that number of ounces has been declining year by year by year. And we're now down to, in 2023, only 830 million ounces. So 896 down to 830 million. And for 2024, the amount of silver to be mined, this is obviously a prediction by the Silver Institute, will drop to 823.5 million ounces, another 1% drop year on year. Um, so that's your supply of silver from mines going down. Meanwhile, we've got the demand from electrical components and industrial demand going up. So if you look here at the demand thing, the industrial demand in 2015 was way below the mine production, about half of it. It was so the mine was 896. The
Yeah.
demand for industrial use was 457. That's been rising year after year, and the industrial demand in the 2023 reached 654 million ounces. But that's not the only demand. Industrial demand is where it was consumed for things like electronics and so forth. But there was also the demand for photography, jewelry, silverware, and physical investment. But what we see is the industrial demand on its own, let's go just deal with that for a second, has risen from 457 to 654 and is forecast to be 710 this year. So rising. But if we add to the industrial demand the jewelry line, which there will be silver jewelry made every year, that's about the same as it was. It's not changed much since
Mm.
2015. It's 203 million ounces. So you add the 654, which was consumed by the industry, to the 203, which went into jewelry in the current year, and you get to 857 million ounces consumed, which exceeds the 830 which was mined. So in 2022 and 2023, for the first time ever, the consumption of silver for industrial use and for jewelry exceeded the mine production. And that figure, as you can see, is going to get worse next year. And the main reason for that is the annualized increase, which in 2023, the electrical consumption, that's where they put silver on electrical connectors and things like that, went up by 20%. That's the consumption for electricity. And the biggest component of that increase was photovoltaics, which are the little solar panels you get on your calculator or you put on your roof or that you put on a battery to charge your devices or on a clock. So electrical use as part of the industrial use is the fastest rising. It's rising very, very fast. I don't think we're going to have less electric devices in the future. So we're going to see a continuation of the demand for silver rising. So that gap between the supply and demand, which already exceed where demand already exceeds the supply, is only going to get wider. Now that gap doesn't include the investment demand, which, according to their Silver Institute, was 243 million ounces last year, and they forecast the investment demand dropping this year a little bit. But it doesn't matter which way you look at the books, if you add the investment demand to the industrial and the jewelry demand, we're now in a massive shortage of silver, and that shortage of silver is growing faster and faster.
Mm.
Um, Interesting enough, the Silver Institute had a forecast of this. Well, the actual silver price in 2023, they say, averaged at $23.35.
Yeah.
I'll stop
Well,
sharing
I
that.
think,
There's got any comments, Mario? What do you think?
yeah, no, I think the physical investment is gonna come to the fore as well. And that's what's gonna push silver a lot higher. And the industrial is gonna continue. I think that's the only thing that's missing is
Yeah,
the
I think it's a rather brave call by the Silver Institute to forecast that investment demand for silver is going to drop by 28% this year.
yeah,
It kind of makes the books balance better if that's true. But if it's not true, the silver price has to go a lot
yeah.
higher to force up the recycling of silver, which would therefore, where does that appear? Um,
I also think, Clive,
yeah,
net
it's here. It's here.
hedging
Market balance.
net hedging demand, that's I don't think they should include that because
No.
they hedge people hedge with paper, which is not real silver. So
Well,
that's
the figure effectively is zero anyway. It's as
yeah,
good
but
as
some
zero.
years it was yeah, quite a big amount. But so should
Uh,
we
but I'll stop sharing that. But
okay.
I think the main point here is that silver, whilst it is an investment metal and it is a monetary metal, the biggest driver of higher prices in the future will be the growing and larger gap between the mine supply and the consumption of
Mm.
silver for industrial purposes, mainly electronics.
Yeah, someone asked Clive, and I think we touched upon that on Friday about the Samsung silver battery. Yeah, that's from William PMCD. Yeah, that battery has been worked on for the last 4 or 5 years by Samsung. I don't think it's in use yet, but yeah, it's going to require a lot more silver. It's going to be a lot lighter, the batteries for EVs made of silver. And I think you also have longer range for cars that have that battery that kind of battery, right, Clive? But I think it's going to still take another maybe 2 3 years for it to become commercial. But and I think it's going to require almost double the silver mine production for a year to make up for that for the new demand, right?
Well, certainly the figures which are out there, if they are to be believed by, I bet they're from reputable sources, suggest that if this new technology using silver in batteries was to become a reality, we might find that the just for the car industry alone, it would consume almost the entirety of the mine production in 10 or 20 years. I don't know how long that will take. Uh, but that's obviously speculation. We don't know if this is really going to happen because those silver batteries are not yet in commercial production, as far as I know. But they're working on it. They started work on it. Oh, they made the announcement 4 years ago originally that they'd got this new technology, but it'll take and it was already working in prototype batteries, but it'll take time before it's suitable to be put in the car. I mean, these things, whenever you invent anything, uh, there's always a number of years pass before it goes into widespread production. But if this comes to pass, as they say, silver in the batteries will increase their lifespan, deliver more power, and make the batteries much lighter than they are in cars. They say that it could add several hundred kilometers to the distance that your car can travel. So I think, if it does happen and they get this technology really working, the demand would be very high. But you don't know when it's going to happen. It might be 5 or 6 years out
Yeah.
now. It might be next year. Who knows?
Yeah, that's what happens sometimes in social media. Someone rehashes like an old article and makes it seem like it's just come out. And that's the case in this one. And I'm not trying to put it down, poo-poo the fact that this battery could be really important, but it's not there yet. Clive, I saw this tweet here or post on X about silver. Uh, it says huge physical silver cartel stress. So what does this mean? It says here this chart shows silver lease rates. That's the cost of borrowing for traders when they have to deliver. It's currently under the most stress in decades. That's because there are only an estimated 132,000 tons of silver uh, for delivery, I guess, on COMEX to 198,000 tons of claims. Something is bubbling below the surface. So that could be another problem, because I think yeah, because silver is very important. I still think um, it is like a barometer of monetary um, let's say, incompetence. The higher silver goes, it shows that the central bankers and the bankers are creating too much credit. So yeah, you can see here like up from 2009 till 2020, it was very steady. This was during the, COVID, so it got pretty wild here, and now it's starting to really pick up, which looks interesting. Um,
So higher lease rates for silver show that people are actually borrowing silver. Why are they borrowing silver? Because they don't want to buy it, but they need the silver for their production. So what they do, they say to one of the big holders of silver, "Can we borrow some silver? We'll pay you an interest rate on it," and they expect to buy it if the price falls. But of course, that all this is doing is putting a floor under the silver price.
Interesting. Yeah, good point. What else have I got here? Oh yeah, talking about actually, let's talk about something here that I have. And a lot of you have seen this before because the thumbnail of the live stream is the pointlessness of holding fiat currency or the dollar continues to sink in. And that's a play on the word on this, Clive. This is an editorial from the FT from 2004 that back then you didn't have iPhones or uh, every morning when I went to work around 6 o'clock, I used to buy the physical FT, and I like turning to the editorial page, and I saw this editorial going gold, and it says the pointlessness of holding bullion continues to sink in. And at the time, I'd been buying a bit of gold for 2 years. And I thought this is a ridiculous editorial, and at the time, price of gold was $400 an ounce. And they basically saying, oh, it's, the central banks, they've done a good job with inflation. The Rothschilds, NM Rothschild, they've quit the gold market. They did quit in '04, making the market making and LBMA. They said gold is going to become more and more useless because our central bankers have everything under control. There's no inflation. And at the end, it says here, whatever the speed, the direction is clear. Gold is on its way out as an investment and a reserve asset. Three cheers for that. So that's what I try to tell people when they read the mainstream media, always to be careful with what they say, because I'm glad, I didn't believe in what the FT said because I'd been studying about money and gold, and I thought this is ridiculous. That maybe they're just trying to get people not to buy gold, and I'm glad I didn't listen to them. But $400 an ounce, I'm glad I didn't. But I'm unfortunately, I think a lot of people, uh, it put a lot of people off because people respect the FT and still do. So,
Well,
uh,
you'll always find the detractors for anything. It doesn't really matter what the investment is. There's always going to be people who say the price is too high or it's not worth anything because it doesn't produce anything. I mean, you could say that about a Leonardo da Vinci painting. It's just a bit of paper and canvas, but there's people out there wanting to buy it. And just this week on LinkedIn, I'd written an article about something about gold. I think I said we should have, I recommended 12% exposure to precious metals. And somebody wrote back to me and said, well, there's no justification for holding gold these days because all money is going to go digital. And I can't see the world going backwards to gold. Well, my answer to him is, well, please explain to me why exactly in this new digital world, if we're all going digital and so on, that gold is standing at an all-time high. The reason it's standing at an all-time high is because a lot of people who don't actually believe that, and that includes a lot of central banks who are out there filling their boots with gold. They don't want to overpay, but they're trying to lay their hands on it, and the quantity of gold in the central banks is rising. And of course, there are other buyers out there because the central banks alone wouldn't be enough to move the market as much as it's moved. So someone out there, and I don't know who it is buying. And it's not one person. I think it's people in Asia in general.
yeah, and there's a guy on Twitter. He works, he's an analyst for the World Gold Council. And lately, you look at all the countries, Poland, they've been the biggest buyer in July. All these countries are buying it. I guess the guy that told you why, gold is irrelevant because of digital currency, digital money, he said. But that's the key there. It's not money, it's digital currency. Digital currency is going to be just as bad as fiat currency because they'll be able to create it as, even more, I would say, than paper currencies, or they're just going to keep it going. What other countries are finding out, non-Western countries, is that the dollar as a reserve asset is becoming less and less reliable, not because it's hard. Well, it's becoming harder to trade in dollars because you have sanctions, but it's the dollar is also losing its value. So I don't expect gold to go anywhere, but not to disappear. Even if you're going to have digital currency, it's probably going to be needed even more. So that person doesn't really understand that money has to be a stable store of value over time, and that's what gold is. And with that, Clive, you've probably seen that, and some of the viewers have seen this because I wanted to also touch upon it. And it goes to show this is from oilprice.com, and it came from Zero Hedge, and I think it actually came from Jan Neuenhaus from Gainesville Coins, and I think he's stopped writing for them now, but recently in June, he said gold surpasses euro, challenges dollar dominance in global reserves. Because usually we don't hear about when they talk about uh, uh, foreign exchange reserves, they don't talk about gold. They just talk about the dollar and the other fiat currencies. But you can see here, Clive, that back in the early 20th century, most of the reserves were in gold because gold is the reserve asset par excellence, if you want to call it that. And it's only after it's been only after 1971 that it's really, well, even in the 50s it started going down because I think the Americans were yeah, they were printing too much money, but now it's coming back. And I think it's going to go back to where it was 123 years ago or so, um, because people are losing faith in this red one, the red ink here. And when
Is that the dollar by any chance? The one which is
yeah,
red one?
red.
Yes.
But all the other ones, they're going to lose faith as well because all the other ones, uh, they're like they're pyramided on top of the dollar. So it's like that's the way I see it.
So the gold is the one at the bottom, which, if I look at the size of that bar, it's just a little bit higher now than the euro,
Yeah, it's a
meaning
bit
that
more than the euro now, apparently. So
yeah, meaning that this is central banks or governments, I guess, are using more gold than euros in their reserves.
and this makes sense because we're seeing since 2022 record gold buying for the first time since I think since around here, since the Bretton Woods. But since the 1950s up until recently, it was on a downward trend. And this is not even including the public. And that's why I think there's still not no euphoria out there for gold because it's just the big guys, the central banks buying, the sovereigns.
Here's a little trivia question for you and your listeners, Mario.
Yeah.
Which country exports the most gold globally?
Uh, Switzerland.
Correct. It's 70, around 70% of the world's exports of gold come from Switzerland. It also happens to be the world's biggest importer of gold. But the reality is, most of the world's gold, something like 70%, is refined in Switzerland, and then it's exported. And where's it going? It's we don't know exactly where it's going because we don't have broken down statistics of that, but it's going to China,
China.
I can tell you.
Yeah. It's funny because Switzerland doesn't mine 1 ounce of gold, I don't think, does it?
That's right. No, no, we've got no gold mines as far as I'm aware of.
I guess they're just good at refining the stuff and
Yeah.
yeah.
I mean, I did when I first arrived in Switzerland. I had two very young boys. We're getting back 45 years, so that I went maybe 30 years ago now. I went panning in one of the Swiss rivers to see if I could find any grains of gold with them. It was more of an experiment. There was no gold, I'm afraid to say.
Yeah, I went some years ago to Wales, and I had a guy who because we had to go into a farm, and he knew the farmer, So we were there all afternoon in penny in the river, and we got a little bit of gold, but it's tiring. It's nice when you see the little yeah, flakes. I think a
Spec, yeah.
speck of gold, because you're really tired, and then you see that, and it gives you a bit of a yeah. I think I still have it here. A few. Can you see that at the bottom?
Yeah, so that tiny spec's probably worth a couple of dollars now.
I think I've got zero point 0.7 of a gram in there.
Okay, so a gram is about $70 or
So
$80, I think.
that was zero point 0.7, so it's about $50 there now.
Wow, that tiny, tiny piece of gold's worth so much.
I think I paid him like over almost 200 pounds for the day because he was like that was his business and I didn't know anything about it. So, and I had to drive to Wales. I spent a couple of days there on my own and it
Yeah.
was nice. Interesting.
It'd be quite a good business to offer people to bring their kids for a day of gold panning, and you could obviously spice it up by a little bit by seeding the river with a little
Mm.
bit of gold flakes.
I'll tell you what the place is called. Though it's spelled Dogalau, but it's actually you pronounce it Dogelith. I'll show you here. It's that's the Welsh. Uh, there you go. That's where I went. Dogalau, Dogelith, and it I think it's yeah North Wales. And let's see on the map. Uh, yeah, so there you go. There, yeah, there's the river. I think we went down the river and he knew someone in a farm there, a farmer. And he the farmer wanted the flakes of gold, Clive. And
Hmm.
I had to put my foot down and I said, no, I don't want to give it to him. I mean, we already, I'll split it with him. So I gave him a few, but I thought it was a bit unfair that I know he
If you
let
paid him
us.
£200 for it, I think it's very
I
unfair.
paid not the farmer, but I paid the guy. Yeah, he could have just paid him something, you know.
Mm.
So anyway,
Just look at the exports from Switzerland of gold. In 2016, Switzerland exported $82 billion worth of gold. And in 2023, it was about 20% higher. They exported, or 25% higher, they exported $107 billion of gold. Obviously, the gold price probably had risen in that period. But it does show that there's a lot of international consumption of gold. When I say consumption, hoarding of gold, because nobody consumes it. It comes out of the ground at one end, gets refined in Switzerland, goes back into the ground at the other end.
yeah, yeah. Some people put it in the. I saw once in when I was in Florence. What's the burger place? The big American thing, not McDonald's, but Hard Rock Cafe. They had something with flakes of gold, so you can consume a little bit, but not that much. Someone's asking how much gold would be needed if all currency could be redeemed. Uh, well, it's more like at at what price? The thing is, it's a bit tricky for people to understand. But if you do your research about gold and money, is that the reason it's money is because there is enough gold in the world, and the supply of gold grows about in line with the growth of the population. And you also have something called stock to flow ratio. All the gold that's ever been mined is above ground. So there's always enough gold. And that's the fallacy that people have, especially the Keynesians in the mainstream. They said, oh, there's not enough gold for it to be money, but there is. And the way to have enough gold is you just change the exchange rate, i.e., the price of gold will go up and there will always be enough gold. I think the
Well,
problem, Clive, is when the bankers and governments they abuse their power and they create too much currency and credit out of thin air, and that makes it look like there's not enough gold.
I've got a precise answer to the guy's question here. The and this is based on the USA. United States has got 261.5 million ounces of gold, and their total debt is 34 going on 35 trillion. So that's that debt has got to be turned into money at some point when they repay it. So if you take the total debt and divide it by the amount of gold they got, you take $34 trillion, which they have to repay. And I'm ignoring the cash in circulation, that's another couple of trillion. You take 34 trillion, divide it by the 261.5 million ounces, and you get an answer of around, very roughly, $130,000 per ounce of gold.
Is that the
Now,
national debt, the 34 trillion you're talking about?
yes, that's the debt of the United States. Now,
What
there
about
was a
the
time
money
when,
supply, though? That would be
well, then you could add another couple of trillion to that. And so the money supply, obviously, the money supply depends which one you take. But if you take just notes and coins in circulation and not the uh, M2 or M3, which includes credit and things like that, but if you just take the notes and coins in circulation, that's about two and a half going on 3 trillion in circulation. So if you just monetize what's in circulation, you'd still be arriving at a figure of over, let's call it 8 to 10,000, maybe over $10,000 an ounce.
yeah.
So there's certainly the supply of money and debt has increased faster than the supply, the amount of gold they've it's faster than the gold price really, because the
Yeah.
amount of gold they hold has the United States has not really changed for decades.
But Clive, for M1 money supply, yeah, you include notes and coins, but you also include bank deposits. So it's actually a lot.
So that's
It's
20
now
trillion.
18 trillion. So
Yeah.
it's huge. And look how much it jumped since 2020. I mean, it's gone up 400%. And it yeah, it has come down a bit because they that reined in, they started raising rates, but I would say now it's starting to, yeah, it's still stabilizing. But M2, because you've always said that, haven't you, Clive, that you should add M2 because like treasury bills are almost like money, right? And that's what you said once, I think. And if you look at this one, that's gone up quite a lot. Not as much as, but that's starting to pick up a bit. And now that they're going to cut rates, I think it's going to go up even more.
Yeah, so I think the next big thing to hit the money markets, and this is over the coming few years, will be a great deal of uh, yield curve control by the United States. I think they're going to be forced into it by the government because the government needs to borrow a lot of money on its present budget, and the market will sooner or later start to get indigestion, won't be able to lend much more, and at that point, the Federal Reserve steps in and buys those government bonds. And what does it buy the government bonds with? Well, it turns on the printing press and prints money out of thin air. And there we have gravy for everybody. The Treasury gets its money. The Federal Reserve has now got a bigger balance sheet. It's richer than ever before. They bigger offices, better computers, dolly bird secretaries. I think everybody's having a great time in the Federal Reserve. And so that's what I think will come. And I think we're probably going to see that starting sometime middle of next year.
Yeah. And someone was talking earlier, Clive, you might know a little more than I do, but I thought that Basel III and using gold as an asset that can be counted for the equity of tier one equity of banks, that's already like in the system, maybe not in the US, but throughout the world. So, and I think it's one of the reasons why the central bankers outside the US have been buying so much gold. But the other thing that I wanted to show the viewers and you is that the IMF, they were always, ever since 1971 and the late 70s, early 80s, when gold and silver almost brought the dollar down, they've been very much against keeping gold in the background and not making it important. But January 2023, they issued this paper, Gold as International Reserves, a barbarous relic no more. You guys can Google this and read through it, but I just think the title is really significant. Basically, the IMF saying, "Yeah, maybe you guys should, you got by you guys, I mean the sovereign central banks, you should be buying gold." And I think it's really significant because the IMF is really the foreign arm of the U.S. Treasury because it's the U.S. Treasury has the most shareholding in the IMF, and they have enough to be able to veto anything. So I thought that was significant as well.
And I think this, you may remember a decade or two decades ago, I think it was the IMF, but for whatever reason, all the central banks around the world were kind of ordered to sell their gold, and they were selling it year after year after year. And there was a lot of pressure on the gold price at the time because of this official policy of selling gold. Um, at some point, some banks stopped selling the gold, and then everybody stopped selling the gold. But so I think what's happening now, we're seeing the central banks of the world buy gold, and they're basically saying we don't really care what you tell us to do, whether you be the Bank for International Settlements or the IMF. We're not actually going to sell our gold. We're going to, you may have your agenda why we should do it, but we're not going to. We're going to keep buying it, and that's what's going on.
Yeah.
So you've got a
Uh,
super chat there, Mario, from
yeah.
Chris Conman.
Thank you, Chris. Once the Fed cuts rates, when will we see the effects of it in the CPI? And do you think the Fed will ever pivot back to fight the raging inflation from cutting rates? Thanks. Um, I mean, I don't follow the CPI too much well, I know where it is, but I don't really follow like the annual numbers and like the components. But I would say it will probably pick up in the next 18 months or so. And if it gets out of control, the CPI, could be a crisis or anything. They could start raising rates again. But I think right now they're going to be quite aggressive in cutting rates. I noticed the twos, tens yield curve spread I closed at -1, -2 on Friday. So I spoke to a friend of mine, Clive. He worked in the bond markets for 40 years and he's retired now. And I started working with him in London when I came from Switzerland. And he thinks the yield curve is going to disinvert by 100 basis points. So he's expecting a lot of cuts. What's your view?
Well, let's just explain what this actually the significance of the yield curve is, because I think maybe a lot of people don't understand it. Uh, the interest rate on 2-year bonds is different from the interest rate on 10-year bonds. So when the longer term rate is below the shorter term rate, the general view is that we're turning into a recession. But when the longer term rate is higher than the shorter term rate, which is that what's happening now, Mario? That we're seeing the shorter term rate dip below the longer term rate.
It's
People start
almost,
to
yeah, almost not
Yeah,
quite.
people start to think, well, we're moving towards not depression or recession, but we're moving towards more of an economic pop boom and also towards inflation. So the longer rates are reflecting the reality that inflation is likely to be higher than the interest rate you're getting on short-term instruments. And just coming back to that super chat about whether from Chris, he said once the Fed cuts rates, when will we see it affect the CPI? The current expectation is that they're going to cut the rates in September, a few weeks away now. the majority think it'll be 0.25%. I remaining cautious and gradual, but there are some people who think it might be as much as 0.5%. And the expectation is those cuts are going to carry on for quite a while. Now, first of all, in terms of how that relates to inflation, when the Fed's target is 2%, but we're not at 2% inflation. The official inflation rate is 3%. And I'm guessing that's about as low as it's going to get. I think that's probably an opportune time for the Fed, if they're planning to cut rates, to do it, because it probably won't be very long before we see that inflation number picking up from the 3%. And certainly after they do cut the rates, that's conducive to higher inflation anyway down the line. That was the first part of the question. And do I think the Fed will ever pivot back to fight the raging inflation from cutting rates? Well, yeah,
Hmm.
I mean, from time to time they'll do that,
Yeah.
but we don't know when. And I think we're going to have a long period of monetary expansion before we get another hike in rates to levels above the inflation rate.
Yeah, so here's the difference between the twos and tens. And as we can see there, it's usually the 10-year will pay more in the normal economy. So, but it's the reason why it goes negative is because the economy overheats. The Fed realizes it's pumped too much. The system has got too much currency and credit in there, too much money, if you want to call it. So they raise the short-term rates, which is the only rates they can control, above the long-term rate. So you get the negative yield curve. You get the inverted yield curve where the short-term rate is higher than the long-term rate. And then uh, after it goes back to flat or disinverted or uninverted, you have a recession, right? And I calculated this and I had a chart. I couldn't find it, but in three of these last four recessions, it's taken 4 months after it went back to positive for a recession to show up. And that's what I think we're going to have. And this happens because the Fed is always behind the curve. So there's a recession now, and they're going to cut aggressively. So the short-term rate goes back down, and the long-term rates probably stay the same or go up because then investors are thinking, oh, the Fed's going to loosen policy again. That's going to create the danger of inflation. So they sell also the longer-term rates. That's how it works, I would say. Anyway. Let's see if we've got any more questions. So I hope that clarifies it, Chris. Uh, we've still got about 12 minutes. Internet Tough Guy says rates are going back to down to 2% at least. Um, they could. Maybe the short-term rates will go back down to 2, but I think the longer-term rates are going to stay above 3, maybe be even near 4. What's your view, Clive?
I think we have a crisis like a recession or some event, a black swan event. And we know black swan events are the kind of events which statistically are supposed to almost never happen, 1 in a billion chance, but they happen all the time. Um, if there's an event, could be a earthquake in California, it could be a pandemic, it could be a meteorite hitting the earth, it could be a war. Who knows? There's lots of things which are unlikely, but at some point something does happen, and it'll probably be none of those. It'll be something I haven't even thought of. But when you have a black swan event, markets do crash, and what usually happens is there's emergency action by the central banks around the world, and they sharply lower interest rates. And just touching on that, unrelated to black swan events, we've had the official numbers from Europe on inflation last week. They were lower, so everybody is expecting the European Central Bank to reduce its interest rate, in a way harmonizing with what the United States is doing.
Yeah, some Echo says he bought 6 ounces of silver this week. That's good. As long as you can keep buying, it's good, I think.
Yeah, I mean, I think it's a great idea. It doesn't cost a lot of money to buy an ounce or two of silver,
No,
and I don't worry too much about the premium you're paying over the silver price. What's
no.
important is you've got something in your hands that will be very useful if we go into a crisis. But also, while you're waiting, if you bought something beautiful, and silver is one of the is I think the shiniest metal. It's certainly one of the shiniest metals, um, and it's got a nice design on it. It's something you can show all your friends and say, "Look what I've got." I think it's great fun to find the beautiful coins, and
Mm.
unlike the old coins of the realm which are not in silver, the ones which are in silver actually look far more beautiful if you could put them into a collection. If you get all the dates or all the logos or all the emblems as a collection, that's even better.
Yeah, someone's asking here, so TLT will go up. TLT is an ETF that tracks the long-term treasuries, I think, up to 20 years. It's supposed to track the 10-year. Yeah, I mean, I think it might go up in price, but I think the 2-year, the shorter end, will do a lot better. So what the professionals in the bond market will do, they will sell the 10-year and buy the 2-year. That's what they will do. But yeah, yeah, the TLT probably will go up because even though the US government is running huge deficits and the debt is going up, they're going to need to print. But I think gold ultimately will go up faster than TLT. So, yeah, what do you think, Clive? Do you
But
follow TLT?
there's a limit to how much TLT can go up. If you think about it, if you've got a bond, it's 10 years, it's got a coupon, I don't know, 3% as an example. Well, it's going to be redeemed at 100, and for the next 10 years, you're going to get $3 a year in income. So unless interest rates go negative, over that 10 years, well, whether interest go negative or not, over that 10 years, you're going to get 10 times your 3% coupon plus your 100 makes 130. So there is a cap on
Yeah,
how high your
yeah,
bond can go.
yeah,
If interest rates go to zero and immediately, then that's worth 130. If they go negative, it might be temporarily trading above 130. But there is a cap as to how high TLT can go or any bond can go. But with gold, there is no cap.
yeah.
But there is actually a floor, if
Yeah.
you like, from another point of view.
Echo, echo. Thank you for your super chat. Wars are expensive, and Ukraine-Russia conflict is financed by Anglosphere. I think the war will continue to drive inflation. Yeah, wars are always costly, and I think also in the Middle East, that's being we're sending money there too, especially the Americans, though. Yeah, there's always inflation during wartime, and it seems like we're in constant wars, Clive.
Yeah, so whenever there's a war, the government has to borrow money to build its factories to make the weapons and so forth. So when a government borrows money, the government gets poorer, and someone, in this case, the manufacturers of the weapons, gets richer, and then a lot of people have got jobs making weapons.
Yeah,
So that's the inflation.
Zelensky gets richer too, doesn't he?
Well, yes. I mean, the bottom line is, of course, war also, from another point of view, can create shortages of goods and services and transportation and other things. But at the end of the day, if the government's got poorer, as is happening all the time, someone else is getting richer. That's more money in the system, which means they can afford more. And therefore, anything which has got a limited supply is going to find its prices dragged upwards.
Super chat from Dimitri. Thank you, Dimitri. Do you think these rates can go negative? Do you think this system would exist long enough to go from cuts to hikes? Um, yeah, I don't think we saw European, like ECB rates go negative, Swiss National Bank rates go negative, the Scandinavian, like Danish and Swedish, I think went negative, but the Bank of England and Fed rates never went negative, so I don't think they will go negative. And it's a good point you make, whether the system will survive another cycle of cuts and hikes. I think it might not. I agree with you. Clive?
Well, Economics 101 says that, used to say, at least when I was studying it, that you will never, ever, under any circumstances, have negative interest rates because nobody would be mad enough to lend money at a negative interest rate. Well, that was proved wrong in the after 2008, as many interest rates all around the world went negative, and in some cases quite seriously negative. Uh, so people were crazy enough. I wrote about it and spoke to my clients about it. I said, some people wanted to buy bonds. They didn't buy bonds. They tended to buy bond funds. And what would happen? They'd be Someone would have pitched a bond fund. They'd be looking at the price, and the price of the bond fund would have gone up and up and up and up. Oh, this is safe investment, government guaranteed bonds. It can't go wrong. But of course, the reason it was going up was as the interest rates were going down and down and gradually going negative, the bond prices were rising, and it got to the point where those bonds had a negative yield. So if you invested 130, you were only going to get back 110, even including all your coupons. And the same thing applied to all the bond funds, but the bond funds on top of that had their charges. So if the average duration of those bonds was 5 years or 10 years, you had 5 or 10 years of 0.5% charges coming out of your fund. So that was going to eat into your return. So I was trying to say to people, on the face of it, traditional economics says holding bonds is a good balance to your risk assets, but it simply was not. It simply was not when we had negative rates.
And I think we got to $17 trillion worth of negative yielding bonds. And the thing about it as well, especially with the longer term bonds duration, when the yields go near zero and negative, the price goes up parabolically. And I think so many people have lost so much money. And I think that's why there was a banking crisis last year, because rates went up so quickly. And I think there still could be. Yeah, it's a big but I don't think the central bankers ever learned. They could go back to, especially the ECB. A. Ron Hubbard says, did you hear about Greg Manorino's march on the Federal Reserve, 7/4/2020? I assume that's July 4th. Here in Europe, we put the day first, not the month first. I think I saw a thumbnail from his one of his videos about that march on the Federal Reserve. I assume that's in Washington, D.C. I'm not sure why he's waiting until next year. And will it make a difference? I think now here in the UK, if we go march at the Bank of England to protest about QE and the fact that Bank of England, Clive, is we're having to give them 20 billion a year to cover their losses on their bonds, which I think is wrong. That's the taxpayer. But they probably arrest us here in the UK if we went to protest at the Bank of England. They call you a far right a thug. It depends. I mean, if Kamala Harris is in charge, if she wins, yeah, it will probably be trouble. But would you? I mean, I'd love to see the Fed abolished, but I'm not sure I'm going to travel from the UK to Washington, D.C. to protest against the Fed. But hopefully, he'll get a lot of people to go.
Yeah, I sometimes watch Gregory Mannarino. I find him interesting and amusing, but maybe I have to be a little bit cautious with some of the things he says.
Yeah, I mean, I
Uh,
agree with what he says about the system. Uh, the system that is not there to help the average person. But
just on the bonds, I remember when we had these negative rates, there was a bond which was issued by Austria, which
oh yeah,
had a
100 years.
it was 100-year bond, and I think it had a coupon of I don't know, so like two or three, 2.4%, I think it was. And that bond, I can't remember the price now, but at one point it was trading at over 300%. Now, to put that in perspective, that not only did that have a negative yield, but it was also uh, you're investing over 300 to get back in 100 years' time just
Mm,
100. Of course, the
yeah.
euro won't even exist by then. So God knows what was in the minds of the people who bought it.
Yeah, I've got it here. Let's see. Uh, okay, here we go. Uh, I'm gonna try to get the.
I think the lowest yield got down was like 0.5% or something. It wasn't quite negative, but it was as good as.
Oh, here we go. We got the history here, Clive. I got this bond. Hold on. So yeah, the price it says here. So this is the 2.1% Bundes online. That's in the Vienna stock
Ah,
exchange.
yes. So,
So it's 2017 to 2117. And the price, I think it was in.
and that's 22. You've got to go back way before that.
Oh, that's the maximum it says here.
Oh, okay. They don't show that's a new bond. That's not the.
Oh, okay. But this one
That's
went up
not the one. Yeah.
153. So if you bought it here, you've lost now like half your money if you bought it
Yeah.
here. Went from
That's
one.
a lower interest rate bond than the one we were looking at. But uh, yeah, there was it. When were these negative rates? The negative rates were sort of before COVID, weren't they? They
Yeah,
were
it topped in 2019.
2015 or something like that.
2019 here, I think this is where there was 17 trillion of all the negative. It was just in the summer of 2019, actually. But now, let's see what the yield is now on these. Doesn't tell you the yield. Well, the yield is going to be a bit more. It's going to be more than two
Probably
because
be like 2.3, I guess,
does it
for
say?
100 years. But it's
Oh,
not much for 100
2.8,
years.
2.8.
2.8. Okay.
I wouldn't want to. I guess fund managers will do it because they'll hold it for 2 years or something.
Can you lend me some money at 2.8%? I'll pay you back in 100 years, Mario.
No, be dead by then. All right.
Yes.
I think it's time, Clive. And do you want to tell the viewers where they can where they can get in touch with you before?
So I'm available on LinkedIn. I don't charge anybody to anybody. I have nothing to sell, no products or anything to recommend. But if people have got some sort of financial questions, they're welcome to drop me a note, and I'll be trying to help them see the way forward.
Great. And Clive, thanks again for coming on. And I wish you a great week.
Thank you, Mario, and thank you for having me.
You're welcome. And thank you, everyone, for your questions, your super chats, and your thumbs up. And if you haven't subscribed yet to the channel, make sure you do. Take care. Okay. All right. I've ended the stream. I think we got quite a few.